This is my channel where I talk about stocks that I think are interesting. So, if that type of content interests you, then please consider liking this video, subscribing to my channel, and that way you will receive uh, more of it as I am doing this all the time. Also, I'll put the link in the description. Be sure to follow me on Seeking Alpha, this website here that we're looking at, where I regularly contribute my analysis in written form as well. Anyways, today I will be talking about Xylem Incorporated, ticker XYL. Very, very interesting company. As always, I'm going to talk about the company, just an overview of what they are, maybe a brief overview of their history. We'll talk about if they have an economic moat, what's the narrative driving the stock price, and both now and into the future potentially. We'll also analyze the financials, the valuation, talk about the dividend. We'll discuss some of the risks that are perceivable when it comes to investing in this. I'm going to give it a grade, buy, a sell, or a hold, as always. And then we will conclude by doing some technical analysis. I will say I've already recorded a video doing this. Sadly, for whatever reason, the video was not saved. So if I do get a little grumpy with you while I'm going through this, it is because I am re-recording this analysis that I've already completed. It gives me a chance to be maybe a little bit more refined in what I'm doing. So anyways, let's get into it. What is Xylem? Xylem Incorporated, together with its subsidiaries, engages in the design, manufacturing, and servicing of engineered products and solutions worldwide. It operates through four segments: water infrastructure, applied water, measurement and control solutions, and integrated solutions and services. The water infrastructure segment offers products including water, stormwater, wastewater pumps, controls systems, filtration, disinfection, biological treatment equipment, mobile dewatering equipment, and rental services under the etc. brands. Okay. Before I go further, let's take this opportunity to talk about what Xylem represents. So, Xylem is a concept in plant biology. Interesting. It's one of the two types of transport tissue in vascular plants, the other being phlegm or phloem. Both of these are part of the vascular bundle. The basic function of xylem is to transport water upward from the roots to parts of the plant, such as stems and leaves, but it also transports nutrients. Okay, so the name is a metaphor taken from plant biology, meant to represent the transfer of water from one piece of the plant to the other. So today, company is described as a large American water technology provider, doing business in more than 150 companies. Launched in 2011 as the spin-off, the water-related businesses of ITT Corporation. ITT Corporation, for those of you who watch my video about Parker Hannifin, ITT Corporation is kind of like that. Specialty components for aerospace and industrial markets like motion control. So the assets in this company were spun out of that other company. What's interesting, if we look at the website of Xylem, just a decade, Xylem has grown from a pump manufacturer to a leading global water solutions partner. So at one point in time, they made pumps. Now, referring again to their description, not only do they have this water infrastructure piece where they sell products, they sell nuts and bolts to water utilities involved in the actual movement, storage, dissemination of water. The applied water segment provide pumps, valves, heat exchangers, controls, and dispensing equipment systems. Same deal there. The measurement and control solutions segment offers smart meters, network communication devices, data analytics, test equipment controls, sensor devices, software management, software and managed services, and critical infrastructure services, and software and devices, including cloud-based analytics, remote monitoring and data management, leak detection, condition assessment, asset management, and pressure monitoring solutions, as well as testing equipment. The integrated solutions and services segment provides maintenance services, mobile services, digital outsource solutions, wastewater systems, environmental remediation, odor and corrosion control, filtration, reverse osmosis, ion exchange, deionization. The idea here is that the company sells products, equipment, but it also sells services both for those equipment and for the services they're a part of. So what that sounds like to me is you have really a parts and infrastructure driven business that is backstopped by a recurring revenue profile as well, to give a little bit more weight to that idea. Let's take a look at the Morningstar report written by this gentleman, Christoph Samalek. The interesting thing I want to highlight here is this. We think Xylem has carved a narrow moat, primarily due to customer switching costs and secondarily due to intangible assets. Xylem's large installed base of equipment generates recurring revenue driven by aftermarket service and replacement parts. Replacement parts and long-term contracts in the measurement and control solution segment. Company's moat is bolstered by intangible assets, including an extensive patent portfolio, reputable brands, and strong dealer relationship. Thanks to its broad portfolio of solutions, Xylem can help utilities address multiple problems of non-revenue water, otherwise known as revenue lost by water utilities due to leaks, unbilled consumption, meter inaccuracy, and so on. So this company has kind of through what it initially owned, through what it has acquired, through where it is going, it is creating a one-stop shop solution for water utilities when it comes to parts, servicing, the infrastructure setup, and then also software and analysis and kind of management services around reducing leakage and efficiency. And so why is this interesting from an investment perspective? Because water security is important. Water security is going to become more important over the next century, I think. And the more integrated this company becomes in water security, the more pricing power it has. And furthermore, we saw earlier, it's operating in 150 countries. So you have the capital expenditure needed in developed nations, and then you have the growth tailwinds in developing nations around, and there's more of a water security need there. So in theory, this company should benefit from long-term tailwinds around water security, water supply, and water quality. And there's lots of growth drivers there. So that's what's driving, the fundamentals we'll take a look at in a moment, but the narrative of this checks out for a long-term investment. In other words, is it creating an investment product with exposure to a very specific industry that will likely, benefit from tailwinds over time? Yeah, it does. And then, does it have a moat? Well, again, we're leaning on our friends at Morningstar to kind of give us some background there. This is kind of like Parker Hannifin. So stock reminds me a lot of Parker Hannifin, where they sell parts, and the more integrated they become in systems, the better they do. Now, one thing that's different about this versus Parker Hannifin is Parker Hannifin, they don't really have this robust like services segment in terms of the like software and stuff, versus this company seems to be a little bit more diversified in that way. So let's talk about the financials. Let's take a look at the financials first. Let's look at the income statement. I always like to zoom out, over 10 years. Revenues were 3.9 billion in 2014. They are now 8.4 billion. That's more than a double. Gross profit has gone from 1.5 to 3.1 billion. For those that are paying attention, that's not quite as fast in gross profit, but almost as much. Operating income, 489 million to 1.1 billion. Also more than a double. So pretty lockstep there. Revenues, gross profits, operating income, very strong performance, all more than a double over the last 10 years. One thing to note here, R&D expenses. They're spending about 7%, a little bit more than 7%, 8% of gross profits on R&D expenses over time. Seems that lockstep's up pretty good. So that's pretty good. What else should we care about? So here is what's interesting about this company. Diluted earnings per share, $1.83 to $3.42. Operating income did more than doubled. So what's going on? Earnings from continued operations, 337 million to 830. That's 2.5 times roughly. So what's going on with earnings per share? Well, that would imply that there's more shares outstanding, and that's exactly the case right here. You see here, weighted average shares outstanding from 180 million to 242 million. That's roughly a 33% increase. We will see in a second what is driving that. There's a reason for that. But before we do that, I want to talk about the dividend here. 51 cents a share to $1.41. That's almost a triple. So the dividend's actually growing quicker than gross profit. I don't know if I like that. And it's definitely growing a lot faster than earnings per share. So what's going on? And you even see here that the payout ratio has ticked up over time. I don't know if I like that. Obviously, dividend growth is good for us shareholders, but this is a more growth-oriented company. You can tell by the fact that revenues are growing a little bit faster than gross profits. In other words, margins aren't, the margin profile of some of these underlying businesses they're acquiring. We know that they're acquiring businesses because of what we've read. I might be getting ahead of myself. Payout ratio is going up, but the underlying business results, very, very strong. Very, very strong. I'm going to come back to these shares outstanding, but first I want to take a look at the balance sheet. So right now we have about $1 billion of cash, 1.7 of receivables, 1 billion of inventory. Notice here goodwill spiked quite a bit. So as intangible assets. So that, along with the fact that, and look here, net property, plant and equipment went up a lot. That does imply that there was an acquisition made along this time frame. That's also, of course, when shares increased, does imply that there was an acquisition that was made. We see that. So again, like I said earlier, I've already done this research, so I won't pretend to be surprised, but I will look up what I looked up last time. 2023, Xylem acquired Evoqua Water Technologies in an all-stock transaction valued at approximately $7.5 billion, creating the world's largest pure-play water technology company by merging capabilities to address water. So that gives you an idea that now we know exactly why our shares went up. But was it a good deal to use shares? Now, obviously, again, if you've been investing for a while, you're more than aware. Real estate investment trusts do this all the time. MLPs do this all the time. Not as common to see corporations use shares, mainly because equity is more expensive than debt. Especially, these days where a company can issue bonds at 5, 6, 7% to acquire these companies. But I actually do like the all stock transaction here. And the reason for that is the balance sheet is pretty good. Again, you think about what it would require for the company to uh, raise $7.5 billion of debt, right? They could afford that, but that is a significant amount of debt, indebtedness. Currently, they have about $2 billion of debt versus their $1 billion of cash. So it leaves the balance sheet looking better, I think. The balance sheet is very healthy. I like the fact that they have enough cash between the amount of cash that they have now and the operating income they generate annually, roughly, they have enough money to pay off the entirety of their debt. So the balance sheet is very healthy, is very strong. The income statement of the underlying company is very good. And then when you kind of dilute it out based on what's been going on, the only thing that sticks out as a negative to me is the fact that we're maybe being a little bit too aggressive in our dividend increases over time. But is the acquisition here accretive? Well, we went from 180 million to 242 million of shares outstanding, and we accreted about $4 a share of revenue, even with that dilution, which is pretty good. Earnings per share, we've accreted, more than 50%. I really like the use of equity to make that purchase. Frankly, I wish more companies did that instead of just being so obsessive about lowering their share counts over time. So yes, I really do like the move there. Income statement looks pretty good. Balance sheet is very strong. What about the valuation? And of course, when it comes to valuation, we're always assessing that both absolute and in relative terms and in yield terms relative to history. So in absolute terms, I would say, just a quick scan of these numbers, the valuation is objectively very expensive. Close, whether on a non-GAAP or a GAAP basis, we're hovering around 30 times earnings. Price sales over 3 times. Price book, 2.5 times. Price earnings growth looks okay. Not cheap, but it looks okay. Not the worst I've seen. The dividend yield is average. We can see it's actually pretty much right in line with being average, maybe a little bit lower than average over the last 10 years, and it's certainly at a local high. So in terms of the yield, the dividend yield looks decent. If you would have retained these shares since they were spun out from ITT, you'd have a 5.68 yield on costs. Not bad. Free cash flow yield, 3.5%. That looks very expensive. So yeah, earnings yield forward less than 3%. Operating earnings yield, I mean, on a forward basis, we're just barely nudging up above treasuries. The valuation is objectively expensive by pretty much every metric. Let's look at the valuation over time. We see in the last year, valuation is substantially less than what it has been at any point over the last year. It's on the lower end of what we've seen in the last 3 years, on the lower end of what we've seen in the last 5 years. It's on the lower end of what we've seen for most of the 10 years, but still significantly higher than what we entered those 10 years at, which was 19 times earnings. And in fact, if we scroll all the way out to all-time trading history, we see that the multiple is significantly significantly expanded over time. It's 14 times earnings when it was spun out, 33 times on a GAAP basis today. On an absolute basis, the valuation looks expensive. On a relative basis, compared to itself, not to peers, to itself, it looks better. Still looks expensive, especially when we look at, versus history. So the current price doesn't scream value to me by any means. It is in a low point. It has meaningfully gotten better, meaningfully come down from all-time highs. So it's a relatively attractive price now compared to what it has been. This is one of the better prices we've seen in recent years where it is now, but it is not objectively cheap. Real quick, I want to look at it. I want to talk about these acquisitions really quick. Xylem has acquired a majority stake in water data management and analytics company Idrica. Deal will enable the two companies to further integrate their solutions. Very strategic here. So I assume that stake comes with a control position. So they control that. At some point, they probably, assuming that goes well, it does appear that they might look to acquire it outright, just like they did with Evoqua. Pure play water technology. So you see kind of the pattern here of what is Xylem doing with their capital stack. They're making acquisitions to expand further up and down the value chain when it comes to what we're doing. This kind of lends itself to the thesis we talked about, where the company is looking to become a suite of products and services tailored to a single end customer. The more components of that system that they have around their business, the more pricing power they have as well. So that really creates shareholder value. They just have to pay good prices, and they have to integrate these acquisitions successfully. So let's talk about some of the risks. Some of the risks here are clearly growth through acquisitions is a core tenet of the strategy here. Um, I think that there's execution and integration risk anytime they look to make an acquisition. I'm not going to stress about that too much because it is what it is. I don't have enough information to really have an opinion about if they will be successful here or there when it comes to that kind of thing. So I would prefer to not speculate on that risk. I think the biggest risk that stands out here to me is just the valuation. The market really likes this stock. There's a lot of reasons why it would be fair to believe for investors out there that at this stage in the stock cycle, especially given the behavior of the index being driven by just a small handful of stocks versus companies like this, which are a large cap companies, $28 billion, having drawn down pretty significantly from all-time highs. What that means to me, the breadth of the market does lead me to believe that this is a stock pickers market, that value plays are more interesting. This is not a value stock. This is a growth stock. You see that in the financials. You see that in the behavior of how it trades, how it outperforms the market here, underperforms. It's more volatile than the market. So this is a growth stock. Growth stocks should trade more expensively. However, when it comes to their earnings, I don't see anything that really makes me super bullish about the company. Revenue is pretty evenly distributed across each of the segments. We see strong growth here in one of the smaller segments, and muted or contracting growth in others. Margins look good, 140 basis points higher. Earnings per share 12% higher than the prior year. Free cash flow much higher on lower conversion. Here, management is guiding to 422 to 424 a share, right? And that's adjusted earnings per share. Q3 2023. These numbers here are on a GAAP basis, I assume. They're not adjusted. Here, we're making a lot of adjustments, right? As reported, operating income, accounting, intangible amortization. Look, I won't weigh in too much here. What I do want to make sense of is that these numbers here are adjusted. They tighten their guidance, raised the lower band, lowered the upper band. They're guiding to $1.12 to $1.14 of growth in the upcoming quarterly earnings, which will be in about 2 weeks, which are about the same as the prior quarter. So look, at the end of the day, growth here, it doesn't look super strong. I urge you to make sense of these numbers for yourself. I feel like they're making big adjustments, and when I look at this, the appendix here for this, I mean, 350 versus 280, that's 25% more, right? And they're basically saying that the difference there is restructuring and realignment costs, special charges, acquisition and integration related costs. Here's the thing that sticks out: purchase accounting intangible amortization. So there's some sort of phantom thing going on there. An intangible asset amortized back to them. So again, I'm not an accountant, but what that sounds like to me is that these adjustments are non-cash. So I don't really want to rely on the adjusted number. But for those who are more accounting inclined, I urge you to take a look at those numbers and tell me what you think. Again, we see very, very large differences in these earnings per share. I don't know if I like that. These aren't the type of things that really bother me because, again, I try not to focus on them too much because what's going on here is there's a solid investment case for this company. The underlying business performance is very strong. I really, really like the end market that they're in, the exposure that gives. I just think that there's valuation in the risk, or excuse me, there's risk in the valuation. There's risk in the maybe not understanding fully what the difference is in those numbers. There does seem to be big differences there that I would really like to wrap my head around more. With there's only so much information they provide, so it might not be possible to really understand it, um, and it might be fairly benign. But I would like to, know more about that there. So that being said, I don't think that there's a ton of risk. I just the valuation that it's at now is relatively attractive compared to what it has been. I mean, you see here, this gentleman here, Zach Bristow, Friday, June 21st. We're not going to read his article, but wait for multiple contraction for this excellent company. Multiple contraction is happened, right? So I do think that the price it's at now is relatively attractive. Um, and, let's look at the technical here to inform if it is a good buy. I've already drawn some lines. We see here that this is the long-term trend line here. Very much intact. That's since 2016 that it's followed in that channel. A little bit, it's still making higher highs within that, but weaker. We failed twice here, bounced, came back up again, broke through this line here, traded all the way up to all-time highs, barely, by about $7 a share. Now we're back kind of testing this zone of prior resistance Will this become a support level? I think if this does become a support level, you see the price bounce up a little bit. Again, we're just talking technically, not fundamentally. If you did decide that you were entering a position here, I do believe that if it were to bounce above this line here and be in this range here, that would be an attractive entry point. I think if it were to fail below this level here, it would be attractive potentially along the long-term trend line. Again, we've seen 3 confirmations of that trend line in a row. Unless there's a huge negative shock in their earnings report, there's really no reason to believe that it won't confirm that trend line again, unless there's very, very bearish sentiment, we're in a recession, something like that, right? I think that is something to consider. Is that what's really nice about this stock is that it has a growth element, but its cash flows aren't discretionary. They're obviously, like any company, they're exposed to the business cycle, but their end customers are utilities, and utilities are very stable, right? So that's who's footing the bill for your cash flows as a shareholder, um, which I really like. I like how my end customers are utilities. I feel like the cash flows of this company are less cyclical than average. Companies like this have traded at premium multiples. Let's talk about Republic Services, Waste Management, companies that are very non-cyclical. Those companies are trading at a multiple around here, maybe even a little more expensive. So I do think the valuation is fair for a company of this quality. Um, I like the underlying business. The performance is good. I think their balance sheet is very sound. I think there's a lot to like here. So I'm going to give it a grade of buy, but very, very soft buy. I mean, this is something that I don't own a position in this. Okay. I don't have a position. Um, I will consider nibbling on a position of it, but I think it kind of is at a pretty critical inflection here, just very short term, that will dictate the short term price moment. Again, the reason that I do the technical analysis piece, when I decide that when I grade something a buy, it's because I think it's a long term viable investment idea. I think it's a viable investment idea, but that doesn't necessarily mean that at the exact price it's at now, it's a buy. And that may be confusing to some of my viewers, but it makes sense to me. Like the way I think about a company is like good company that I'd be happy to own. That's a buy. Um, and at the price it's at now, the exact price, it's a buy. But it may need to be a little bit showing more bullish momentum or a little cheaper for it to really be a buy. That being said, if I had capital right now to buy shares of this, which I don't, if I had capital right now, I might consider it. But I do believe that we're close here to seeing potentially a better entry point in the very near future. So I'm going to continue to monitor this. I've added it to my watch list. Shout out to my friend Owen. He actually is the one who told me about this company because he said it looked interesting. Um, that's why I heard about it. So shout out to you. Hopefully you're watching this. Hopefully you're liking and talking shit in the comments or something. Anyways, um, so yeah, I like the underlying business. It's not screaming buy. It's not a screaming buy right here. It's not drop everything and buy, go into debt kind of buy here. Um, in my opinion, but I do like the company. I like its long term prospects, and I like their numbers look good enough. So, uh, yeah, I think that'll conclude our video today. Hopefully, you found this interesting. I've certainly had a good time talking about this company with you today, and I hope that you visit again. to listen to me do more of this analysis. If you found this interesting, then please consider liking the video, subscribing to the channel. I hope to be seeing you again soon. I'll sign off now. Have a good rest of your day. Thank you for watching.